Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Hubbell stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 20 billion market cap. They're trading at $3.68 a share and they have 54 million shares outstanding. Hubbell designs, manufactures, and sells electrical and utility solutions in the US and other countries. It has two segments, electrical solutions and utility solutions. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Their free cash flow was identical in 21 and 22. These numbers are rounded to the nearest million. If you go out a decimal, you'll see they're not identical. Revenue peaked in 2023 at over 700 million. It's a little under 700 million in the trailing 12 months. Decent margins, 13%. That means they convert 13% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also positive each year, peaking in 2023 at 760 million. Margins are in the low double digits. Revenue is the sales for the company, and that goes up from 4.2 billion to 5.5 billion. Not huge growth, but they are growing and they're profitable, which is a lot better than most companies. And they pay a 1.3% dividend, which they can easily cover, because they have almost 700 million of free cash flow. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year 4, that's 15 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $14 billion. We divide that by 54 million shares. And we get a calculated stock price of $2.59. They're trading at $3.68, so they're trading at a 42% premium. It's a big sell according to the model. A lot of companies lately seem to be overvalued. But I would feel a lot more comfortable owning this stock than a lot of other stocks we looked at recently, because they have positive free cash flow. So they look like a great acquisition target. There are 26 companies in the same industry as Hubbell, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 170 million in CapEx. These are the investments in property, plant, and equipment. Plug is number one at 614 million. Debt to equity ratio is decent at 0.7, pretty close to the median. They pay a good dividend, second highest on this list. They generate a lot of free cash flow, second most on this list. A really good market cap, second most on this list. I just like saying that. They're trading at 7 times book value, worse than median average. 27 times earnings, also worse than median average. 29 times free cash flow, better than the average. And 3.5 times revenue, which is a lot better than the average. They generate the second most amount of revenue behind Vertiv. And their 5-year annual revenue growth rate isn't so great, only 4%. Plug is number one at 36%. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $41,000 today, a 17% annual return, a 300% total return. Let's take a look at their income statement. This is the first quarter of 2024, 1.4 billion. In the first quarter of 2023, it was 1.3 billion. I like to understand how a company generates their revenue. Let's see if they give more information. Of the 1.4 billion of revenue, 900 million from utility solutions, 600 million grid infrastructure, 280 million grid automation, both up from last year. Then they have 500 million of electrical solutions, electrical products 212 million, connection and bonding 175 million, industrial controls 97 million, and the only thing that's down is retail and builder 21 million. Last year was 52 million. Here's their revenue by location, 850 million US, 40 million international. That's in utility solutions. In electrical solutions, 430 million US, 70 million international. International revenue in utility solutions is down a little bit. And US revenue in electrical solutions is down a little bit, but the other two are up. In utility solutions, operating income 158 million, but it was higher last year with lower revenue, 178 million. And revenue was 100 million lower last year. So their margins are worse. It was 23% in the first quarter of 2023, now it's 18%. In electrical solutions, operating income and margins are flat. Here's a condensed income statement. Below revenue is cost of goods sold. These are all the expenses directly tied to generating the revenue. So gross profit, $448 million. So gross margin is 32%. Gross margin is gross profit over revenue. The percents are percent of revenue. So gross margin is down from last year. Last year was 35%. SG&A is flat in terms of percentages. 15.7% this year, 15.5% last year. Operating income is down. It was 19% last year, now it's 16%. Net income is also down. It was 14%, it's 11% now. Net income is their accounting profit. When we look at their statement of cash flows, we could see how much cash they generated from their operational business. And they did increase their shares outstanding, very little, 53.9 million last year, now it's 54 million. It looks like they don't split because they don't have that many shares outstanding. They have two divisions, utility solutions and electrical solutions. Let's see how they define those two. Utility solutions consist of businesses that design, manufacture, and sell a wide variety of electrical distribution, transmission, substation, and telecommunications products. This includes utility transmission and distribution, T&D, such as arresters, insulators, connectors, anchors, bushings, enclosures, cutouts, and switches. They also offer solutions that serve the utility infrastructure, including smart meters, communication systems, substation control and relay panels, and protection and control devices. The Hubbell Utility Solutions segment supports the electrical distribution, transmission, water and gas distribution, telecommunications, and solar and wind markets. Pretty wide reach. Products are sold to distributors and directly to users such as utilities, telecommunication companies, industrial firms, construction and engineering firms. The Electrical Solutions segment sells standard and special application wiring device products, rough-in electrical products, connector and grounding products, light fixtures, components, and other electrical equipment. Their products are usually used in and around industrial, commercial, and institutional facilities by electrical contractors, maintenance personnel, electricians, utilities, and telecom companies. They also design and manufacture industrial controls and communication systems used in the non-residential and industrial markets. Their products can be used in harsh and hazardous locations. They can even handle high temperature if there was a fire, for instance. Their harsh and hazardous products are used in the oil, gas, and mining industries. Let's look at a statement of cash flows. The first section is operating cash flow, and they generated $92 million of cash. Last year was $114 million. To calculate the $92 million, you have to start with your net income, $150 million, and then we have to convert net income to cash. So we have to add back the non-cash items on the income statement. The biggest is depreciation and amortization, $60 million. Then you have stock-based compensation, $13 million. A negative $85 million in accounts receivables. This means they sold product on credit and did not get paid for it. They will get paid in the future. They spent $23 million on inventory. It looks like in the past, they sold on credit and they received the money this quarter, $39 million of accounts payable, and a $93 million cash outflow in current liabilities. This does not include accounts payable. In their financing section, they spent $40 million of CapEx. It looks like they sold one of their business units and received $122.9 million. The $123 million was the result of the sale of our residential lighting business. They talk about it in a lot more detail here. In December 2023, we sold our residential lighting business for $131 million. And this sale resulted in a pre-tax loss of $5 million. Here are the balance sheet items tied to this sale. $30 million of accounts receivables, so the company that acquired them will receive these accounts receivables. So the payments the customers make will go to the new company. $38 million of inventory, $63 million of goodwill, that was the bulk of it. Goodwill is the premium you pay when you acquire another company. So they sold this for $63.5 million above the net assets. And the company acquiring them also has to take on the debt, all the liabilities. $24.6 million of current liabilities, $17.5 million on non-current liabilities. So in their investing section, they had a cash inflow of $89 million. In their financing section, they paid back $125 million on long-term debt. They borrowed $98 million on long-term debt. They paid $65 million of dividends. And it looks like they bought back 10 million of their own stock. Last year was 20 million. So in their financing section, they had a cash outflow of 125 million. So cash at the beginning of the accounting period, 336.1 million. Cash at the end of the accounting period, 388.2 million. The difference between these two numbers is a sum of operating, investing, and financing cash flow. So it went up about 50 million from beginning to end. 388 minus 336 is 52 million. So 90 plus 90 is 180. 180 plus 125 is 55. I'm just rounding. But remember these two numbers, 336 spot 1, 388 spot 2. That's the cash on the balance sheet, 336 spot 1, 388 spot 2. Let's look at a stock on Simply Wall Street. Its last price, 375, 21 billion market cap. Up 2% in the past week, up 17% in the past year. It looks like that stock started trading a long time ago, back in 1990 at $18 a share. And it's up about 22x from there. It did break through $400 this year. So it looks like a great stock to own, a great company. Simply Wall Street's valuation is 352. They say the stock is overvalued. 9 analysts priced this stock at 408. They say it's undervalued. The revenue forecast for this year is 5.9 billion, then 6.2 billion, then 6.5 billion. Free cash flow forecast for this year is 800 million. Next year, almost 900 million. Then it's 930 million. Here's their debt since 2013. It was only 600 million then. It jumped way up to 2 billion in 2018. Then they started paying down that debt and they added a bunch more. Now it's 2.1 billion. But their equity is usually higher than their debt. Currently equity 2.9 billion, debt 2.1 billion. And they have a little bit of cash on their balance sheet, enough to service the debt, 400 million of cash. Their dividend back in 2014 was 1.7%. It peaked at 3% in 2019, but it's come down because the stock price keeps going up. It's 1.3%. The forecast is 1.5% by 2026. The CEO's salary went from $500,000 to 1.1 million. Total compensation, 10 million. Tenure as CEO, 5 years. In the past year, there's been a lot of insider selling, just 3 buys. 91% of the companies owned by institutions and 9% by the general public. Vanguard is the biggest shareholder at 12%, BlackRock and Fidelity. Geode, Invesco, Impax. We know Impax is a British company, PLC at the end. Norges, a Norwegian company. United Bank Asset Management in Fairfax, Virginia. And their employee count has gone up a little bit from 14.5 thousand to 18.4 thousand. And the ticker trades on the Deutsche Börse, New York Stock Exchange, and Mexican Bolsa. Let's learn a little more about the company on Wikipedia. They're headquartered in Connecticut, and they were founded way back in 1888. They've been around a long time. They do manufacturing all over the world, the US, Canada, Switzerland, Puerto Rico, Mexico. And they also have sales offices in China, South Korea, the Middle East. And their founder, Harvey Hubbell, invented the electrical plug. You know those plugs that are in the wall? He invented them. He also invented the pull chain light socket. They were named one of the world's most ethical companies of the year for the 4th time. I'd much rather invest in a company like this than a company without ethics. And like most public companies, they do a lot of acquisitions. 1962, Kellum's company. They sold mesh grips, cord connectors, and wire management products. And you can see it's a really long list of acquisitions. Every year they acquire somebody. A lot of these are smaller companies we haven't heard of. See, it's a really long list. They acquired Burndy in 2009. They manufacture and sell compression and mechanical connectors. Wiley Electronics, Vantage Technology. Wikipedia is a great place to get info in English. Of course, the 10K and Q are in English, but the wording is kind of abstract. They kind of dumb it down in Wikipedia. It makes a lot more sense. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. Thanks for watching.